Most of you are building a tax bomb and don't even know it. You've been told the 401k is the gold standard, but by the time you reach 65, the IRS might be your biggest beneficiary. Today, I'm doing a head-to-head math breakdown, 401k versus indexed universal life. One of these gives you a tax break now, the other gives you a tax-free fortune later. Let's look at the numbers. You're 35, you put $500 a month, your boss puts in $500 a month, that's $12,000 in a year. At a 7% return in 30 years, you have $1.1 million. Sounds great, right? Wrong. That $1.1 million isn't yours. It's a joint account with the IRS. At a 25% tax rate, you lose $280,000 instantly. If taxes go up, and looking at the national debt, they probably will, you're losing nearly half of your nest egg to Uncle Sam. Now let's address the elephant in the room. Fees. You've probably heard the IULs are too expensive because of the cost of insurance. Let's look at the math because numbers don't have emotions. In your 401k, you might pay a 1% management fee. That sounds small, right? But that fee is calculated on your total balance. When your account hits $1 million, you are paying $10,000 every year in a single year, regardless of whether the markets are down or if they went up. As your wealth grows, your fees grow. It's a tax on your success. In a properly structured IUL, set to the minimum non-MEC death benefit, the cost of insurance actually becomes more efficient over time. The net amount at risk, you only pay for the insurance on the gap between your cash and the death benefit. As your cash value climbs towards that death benefit, the amount at risk shrinks. So does the relative cost. Yes, the IUL has higher cost in the first 10 years, but in a 401k, the fee you aren't counting is the deferred tax. A 1% 401k fee plus 25% tax at the end is mathematically much more expensive than the front-loaded IUL cost. That buys you a zero tax rate for life. Would you rather pay a small fee on the seed now or a massive tax on the harvest later? I'll take the upfront cost to keep 100% of my growth every time. Now, look at the IUL. We've funded it with the same $1,000 a month. We've structured it for the minimum death benefit and the maximum cash. The floor, when the market crashes 20%, your 401k loses $200,000, your IUL stays at zero. You never lose your principal. We're assuming a 10 to 12% average because we aren't losing 30% in a bad year. In retirement, you don't withdraw money, you take a private loan from your policy. Loans aren't taxable income. You get 100% of your check. The 401k is a maybe strategy. Maybe taxes stay low, maybe the market doesn't crash the year you retire. The IUL is a certain strategy. If you want to see if you qualify for a max funded structure, click the link below.